Section 1:1 Understanding the Volatility Index, VIX, Definition and Purpose. The VIX, also known as the CBOE Volatility Index, is a widely used measure of market volatility and is often referred to as the fear gauge of the financial markets. It was introduced by the Chicago Board Options Exchange, CBOE, in 1993 and has since become a popular tool for investors, traders, and analysts to assess market sentiment and gauge the expected level of volatility in the future. The VIX is derived from the prices of options on the S&P 500 index, which is a benchmark index of the U.S. stock market. Specifically, it measures the market's expectation of volatility over the next 30 days. The VIX is calculated using a complex formula that takes into account a range of option prices, strike prices, and the time to expiration of those options. Implied volatility is a measure of the expected future volatility of an underlying asset based on the prices of options on that asset. It represents the market's collective estimate of how much the price of the asset is expected to fluctuate over a given period. Implied volatility is an important concept in options pricing because it affects the premium that options buyers are willing to pay. When implied volatility is high, options tend to be more expensive, reflecting the increased uncertainty and potential for larger price swings. The VIX serves as a measure of implied volatility in the market because it reflects the expected volatility of the S&P 500 index over the next 30 days. It is often used as a contrarian indicator, meaning that when the VIX is high, it suggests that market participants expect increased volatility and potential market downturns. Conversely, when the VIX is low, it indicates that market participants anticipate lower volatility and a relatively stable market environment. Investors and traders use the VIX in various ways. For example, some use it to assess market sentiment and make decisions about their investment portfolios. Others may use it to hedge their existing positions or speculate on future volatility. Additionally, the VIX is sometimes used as a benchmark for volatility trading strategies and as an input in options pricing models. It's important to note that while the VIX provides valuable information about market expectations, it is not a direct measure of future market movements. It is a reflection of market sentiment and can be influenced by a variety of factors such as economic indicators, geopolitical events, and investor behavior. Therefore, it should be used in conjunction with other analysis tools and indicators to make informed investment decisions. The VIX, also known as the CBOE Volatility Index, is a popular measure used to assess market sentiment and gauge the expected level of price volatility in the financial markets. It is often referred to as the fear gauge because it reflects the market participants' expectations of future volatility. The primary purpose of the VIX is to provide investors and traders with an insight into the level of uncertainty or risk in the market. It is calculated based on the implied volatility of S&P 500 index options. Implied volatility represents the market's expectation of how much the S&P 500 index will fluctuate over a specific period. The VIX is calculated using a mathematical formula that takes into account a range of options on the S&P 500 index. It measures the expected 30-day volatility and is expressed as an annualized percentage. Higher VIX values indicate higher expected volatility and are often associated with increased market uncertainty and fear. There are several reasons why the VIX is useful in assessing market sentiment and risk levels. Volatility expectations. The VIX provides a snapshot of market participants' expectations regarding future price volatility. When the VIX is high, it suggests that investors anticipate larger price swings in the market, indicating higher levels of uncertainty and risk. Conversely, a low VIX value indicates expectations of relatively stable market conditions. Contrarian indicator. The VIX can also act as a contrarian indicator. Extremely high VIX values may signal that fear and panic have reached extreme levels, indicating a potential buying opportunity, as markets may be oversold. Conversely, very low VIX values may indicate complacency or excessive optimism, which could precede market downturns. Risk management. The VIX is a valuable tool for risk management. Investors and traders can use the index to assess the potential risks associated with their portfolios. Higher VIX levels may warrant adjustments to risk exposure, such as increasing hedges or reducing leverage. Conversely, lower VIX levels may signal a favorable environment for risk-taking, portfolio diversification. the VIX can help investors assess the diversification benefits of adding volatility-related products, such as VIX futures or options, to their portfolios. These instruments allow market participants to hedge or speculate on market volatility directly. It's important to note that while the VIX provides valuable insights, it is not a predictor of market direction or precise timing of market movements. It reflects market expectations and sentiment, which can change rapidly based on various factors such as economic news, geopolitical events, or market sentiment itself. In summary, the VIX serves as a useful indicator of market sentiment and risk levels. It helps investors and traders assess market volatility expectations, identify potential buying or selling opportunities, manage risk in their portfolios, and evaluate the diversification benefits of volatility-related products.